Hello and welcome to our workshop. Today, I'm excited to bring in a dear pal of mine to talk about a topic that I think is super important. He's calling it Millionaire Strategies, what the banks don't want you to know. And I got to say, this topic has been showing up on my radar recently in multiple facets coming at me. And it's one of those things that I wish I had learned a long time ago. So trust me, this is going to be a valuable talk. You're going to want to pay close attention, take some notes. And so, without further ado, let me introduce my guest and dear friend, Michael Hession. Michael has been an entrepreneur and business owner since, gosh, starting his first business at 26 in the marine industry, which he ran successfully for 16 years. And for the past 11 years, he's been a licensed insurance producer, and for the last 5, an authorized practitioner of the infinite banking concepts, so designated by the Nelson Nash Institute. Nelson Nash was the founder, of course, of Infinite Banking. And through this approach to personal wealth management, he's helped more than 50 individuals and families to take control of their financial lives for this and future generations. He's an Amazon best-selling author and has been featured in more than a dozen podcasts. So please welcome Michael Hession. And Michael, I'm just going to turn this over to you. I'm going to spotlight you, and then I'm going to fade into the background and let you take it away.
All right. Thank you, Michael. Good to
You
be here.
betcha.
So I'm so happy to be here, and I love this topic and teaching people about this approach to personal wealth that most people don't know about and need to know about. So before I get started, I'd like to just give you a little bit of background just to show you and my journey to here. It makes a difference. I think it'll make more sense to sort of share that with you so you know why I ended up doing what I'm doing now, because it's informed very much by my own personal history. Real briefly, so as Michael mentioned, I started my first business a couple of years out of college in the marine industry. My father had helped me set it up, and it was a small marine canvas shop. I made custom boat covers and tops in southeastern Massachusetts. And I did that for 16 years. At some point, I just burned out. My father, unfortunately, had passed away a few years into it, and it was just me at that point, and I just burned out. I'd gotten married, we had kids, and I was having to commute a lot, and just a lot of reasons to sort of walk away from that. Shortly before that, my wife and Ann and I bought our first rental property, which actually was our first home. So before I shut that business down, I started to be in the world of investing, and in this case, it was real estate, and to see the importance of having leverage in your life, and in our case, having a tenant pay towards the mortgage, paying towards hang on a second, letting someone in. Just having someone else help cover the mortgage expense. And around the same time, I also was learning how to trade in the markets and options, futures, and currencies, and self-directed trade in the markets with my own money and other people's money as well. And I learned a lot that way. And this was in 2006 and 2007. And I just really got to see what the flow of money back and forth, and just this wealth just going back and forth out there in the ether, as it were, in the electronic world. And I learned a ton. And so I did that. My wife and I had this real estate property. We had turned that 2 unit into a 6 unit. We were thinking this is going to be the beginning of our real estate empire. In 2007, we had that. My wife had started an online business. We lived in our current house, which we are still in 20 something years later. And things looked really good. We were in great shape, we thought. And then, of course, 2008 happened. And I'm sure some of you out there experienced what that was like in 2008. It was like a tidal wave for a lot of people, and we got caught up in that as well. Our foundation wasn't really solid enough to withstand what happened to the broader economy, and I'll touch into that later on this, what I'm going to talk about, and these strategies that the banks don't really want you to know. So it took some time coming out of that. It was a real, our bankruptcy was discharged in 2008, September, and it was a real kind of crawl out of that. Eventually, I got into some sales jobs because I hadn't worked for anybody in 20 years. So I got a few odd jobs here and there. Eventually, I worked my way into the financial space because I had between the investing in the real estate and the trading in the markets, I was interested in that and how money works. So I ended up working for a life insurance company. And that was a real eye-opening experience because I got to see what life insurance was. It was so much more than what I thought it was. Eventually, I learned about this thing called infinite banking concepts about 11 years ago. Started our first policies and really learned how utilizing a certain type of whole life insurance contract is immensely beneficial to people and is something that was very common in the last century and has kind of been forgotten about. So part of my job is to reintroduce people to that, the power of these whole life insurance contracts done the right way. And so that's what that led me here. Is a long and winding road, a lot of pitfalls, but part of my motivation is to educate people on this so that when the next thing happens, they'll have a stronger foundation and be able to withstand it. So I'm gonna start my PowerPoint and just to share my screen here. Let me get that up and running. I'll ask a couple questions too along the way. So if you're attending, if you could please just pop in and your answers, I appreciate that. So okay, let me hang on a second. Okay, so this is a presentation that I really like that is with a firm that I've recently partnered with. So I've been kind of on my own. I had a mentor with infinite banking starting about 7 years ago. Was with him for a bit and then kind of on my own. And recently I partnered with this firm called Factum Financial out of Arizona. I really like what they're up to, and they're playing a big game to get this information out to as many people as possible. And their heart is in the right place. So, and I love this presentation, so I'm going to use this one as we go along the way. So, okay, let's dive into it and beat the banks. That's what or another way to think about it is, if you can't beat them, join them. So, in other words, if you can't beat the banks, do what they're doing, or as closely as you can approximate what they're doing, and the reason that they are so successful and really kind of run the world. If we're being honest here. Okay, so. Something that I like that's often not thought about in a world of finance, being a financial professional for as long as I have been, is this idea that, really if you look at different areas of life that are important, they could be any number, but these 5 are sort of general categories. And that if things are right and in alignment and you're nurturing all these different areas, you've got a pretty great life. There's a spiritual side, however that might look for you, whether it's a belief in God or a higher power or the universe or whatever that might be. That's sort of, that mystery that is the spiritual world, why we're here, where we come from, all that kind of thing. And then the personal side, our health and things that really light us up could be hobbies and exercise and just becoming a better human being. And an occupation, of course, is the job that we have or the business that we have. Does it light us up? Does it feel like we're making a difference? Or is it just for a paycheck? And then at the bottom here, bottom right, is family, of course. If you have kids or a spouse or whatever family is in your world. And then, of course, on the financial side, which is my focus, and which I think we can all agree hugely impacts all these other areas. I know for us, that period that we went through back in 2008 put a tremendous amount of stress on mine and my wife's relationship, a tremendous amount of stress. So it tends to have a huge impact on these other areas. So one of my goals is to show people how, if they can get that handled, then you can almost focus on these other areas a little bit more intentionally. Now, is it possible? I want you guys to think about this, that there's a better way, more efficient environment to store your wealth than what we're typically taught. And what we're typically taught is either under the mattress if it's cash, or to a bank. That's just kind of what you do. I remember coming out of college, no one taught me anything about financial literacy, and I started to get these credit card offers as a 18 or 22-year-old college graduate. Had no idea what I was doing, but suddenly I could get a credit card and start getting stuff. even though I had no way to pay for it. So is there an environment that's more conducive to savings? And the answer is yes. I'll get into that. So these are what I view and we view as the key components of wealth building to really have it work through tough times and good times. And that is, let me just move this out of the way. Hopefully that's not being seen. Here we go. So financial education, financial awareness, and then the saving strategy down here on the bottom right, which is the infinite banking concept, where a certain type of whole life insurance policy, they are at the foundation of your building your house of wealth. And these can be different. If it's just a single family, it might be the foundation doesn't have to be super involved. But if you're building a skyscraper has a different type of foundational requirements than a home does. So everyone's a little bit different, but the important thing is to have a foundation that's really solid that you can build upon. Because if you get ahead of yourself, okay, hang on a second, my slideshow, hang on one second, it's not working. I don't know why. Sorry about that. For some reason my slideshow has decided to not move. Let me try going back. Apologize for this. I'm going to stop share for a second. Do I want to go back in? No. Oh, here we go. Okay. So I have to go back, share again. Sorry. Technical difficulties. Let's try that again. Okay, let's try that again. Okay, so as I was saying, with these foundational down at the bottom, in order to build a solid structure, eventually you can get towards the top of the triangle, which is really freedom. And you hear people talking about financial freedom, and that's an area that you can play in when you're up here at the top and your foundation is such that you can comfortably do that. You can comfortably travel. You can do whatever you want. And there are people who are doing that. And I think it's good. It's important to understand that the reason is that they have this really solid foundation. What I think tends to happen in this country, in the U.S., is that a lot of things that you see out there for wealth building are up in this area. They could be things like the lottery, get rich quick things. Gambling is huge. You look at sports gambling, all these things that are very speculative and usually aren't going to work out if you look at it statistically. And usually the house wins out, whether it's Wall Street or the casino or whoever it is. So people are playing in this area and they don't have a solid foundation that will allow them to play up in this upper part of the triangle comfortably. So you see here, this bottom half of the triangle are all these things, the very bottom, and then you get into here, property and casualty, coverage for your home, liability, auto insurance, all that stuff that we all have to do. But then there's also a debt strategy. If you have outflow of money, is there something that you can do to affect that? And obviously life insurance, health insurance, disability, income replacement, long-term care. There's a huge problem with that. The numbers are not good. It's in the States, it's something like 70% of people after they reach the age of 65 will require some form of long-term care, some sort of nursing home care or assisted living, home health care or something. People are getting older and at some point they can't take care of themselves, but they're still alive and doing their thing. They can't take care of themselves. And one thing that's really nice about some of these whole life insurance contracts that I'll be talking about is they have a long-term care component built into these contracts. So if it ever gets to that point, you can take advantage of them as well. So I'll keep going. Oh, I don't know. My thing keeps, sorry, I don't know why. I apologize for this. My PowerPoint is acting up. I don't know why. Try that again. All right, let's try it again. All right. Apologies. Here we go. Okay, we got these, and now in this top level, this is where once you have that base really handled, that you can start to play in this area on the top part of the triangle and actually have it work for you. So one thing to think about is that in all these different areas, where there's down at the bottom with financial awareness and insurance, asset protection, trusts, and that kind of thing, even in the upper in investing strategy, there's one thing that's tied, that is sort of like the connective tissue for all of these things, and that is banking. So the banks and banking have their hands in all of this stuff. They are sort of like the ultimate middleman. This is something that R. Nelson Nash, who's created the infinite banking concepts, talks about in his seminal work called Becoming Your Own Banker. And it's really, he wrote this book. He'd been teaching seminars back in the second half of the 1990s to teach people about these whole life insurance contracts, and so that they would understand how to use these things. And he wrote, that's why he wrote this book, is basically this seminars put into a form of a book. And this is really important. There are sometimes people will learn or hear about infinite banking concepts and they'll confuse it, conflate it with investments. It's not. This book is not about investment of any kind. It is about how one finances things in life, which can certainly include investments, but it's not about rates of return. It's a very important distinction. So here's the problem. The problem is you finance everything in life. When you think about it, you either borrow money and lose interest in the ability to earn money on that money, or you borrow money from lenders and pay interest to them. So it's usually one or the other. There might be some circumstances where you barter, but typically you either save up your money and pay cash for it, and you don't have any ability to earn money and earn interest on that money, or you borrow from lenders and you pay them interest. That's a real problem. I have my mentor talked about it this way, and think about it, everybody has their own economy. And most people, it's sort of the shape of a horseshoe. It's open-ended. Money comes in and money goes out. You hear people say it all the time. Money comes in and then money goes out. And it doesn't stay inside your system. So part of our goal with this is to start to close that loop, so that you have your own economic system where you're able to use the same dollars more than once. So this is, I'd like you guys to chime in here. This is a very interesting way to think about income levels, because I would submit that in this country, income for most people is not really the problem. It's that we don't keep the money that we do earn. So if you were to think about, on average, US families, what it would require in annual income to be in a top 50th percentile in this country, what do you suppose it would be? Anybody going to pop in the chat? This is an interesting exercise to think about. So what amount of money would it take to be in a top 50th percentile in the US currently? No one yet? Okay, I'll keep going. Oh, it's doing it again. Sorry, folks. My computer is not cooperating again. I have to. Sorry, Michael. Yeah, my advanced thing on the PowerPoint keeps stopping. I don't know why. Try that again. Yeah. Apologies, folks. I've used this thing very recently and it wasn't doing this. Okay. Okay, Let's try it again. Okay, so top 50th percentile, $41,740 a year. What do you think the top 25th percentile might be? $83,000, 682. And how about the top 10 percentile in this country? 145,000. These numbers, when I first saw them, were really surprising. These are a government study that was done on these numbers. How about the top 5% in the US in income? 208,000. And how about the 1%? People tend to think of the Elon Musks of the world and Jeff Bezos, and you think about these billions of dollars that they have, but just for an average people, what do you think the top 1% might be? Just over 500,000. That's really surprising to me. So if you're in this range, congratulations. Really, in any of these ranges, you're doing really well relative to, on average in the US. And then take that a step further. If you're looking at worldwide income levels, what do you think it would take to be in the top 1% worldwide? $34,000, which is pretty crazy to think about it. So that's why I think as crazy as things can seem in this country, we just came through a very contentious election, obviously. And I think it's good to step back and realize how good we do have it in this country, even with all the messy aspects to it, especially when it comes to income. So what's the problem? So worldwide, people in the top 50th percentile in the US are in the 1% worldwide. So here's some ideas on common versus uncommon. Savings rates. What should you be saving? Most people, there are a lot of books out there who will talk about 10%. Your Robert Kiyosaki books, Rich Dad, Poor Dad books, Becoming Your Own Banker. 10% is often put out there as an ideal amount to save or pay yourself first and keep for yourself in savings. You can see here from a recent study from July of this year that the current personal savings rate is 2.9%. The US is kind of notorious for not being very good savers, unfortunately. That's not always been the case. And you can see here, you have occasional spikes, but it's below 5% on average. During COVID, there was a huge spike up, and then it kind of dropped and drifted back down to its sort of current levels, which is well below 5%. Oh, come on. Sorry, it's doing it again. Sorry, I have to go back. Try to go a little faster, see if that works. So we have these numbers here. Common is 5% or less. What would an uncommon amount be? 10 to 30%. What if you were saving that much of the money coming into your system and you're keeping it for yourself? Now, if cash was king, who has it? This is another recent study from JP Morgan Chase about small businesses across the country and looking at how much liquid cash they have in reserve. How many days could they survive if things suddenly shut down? Certainly in COVID, a lot of businesses went out of business because they did not have the reserves to withstand that external event. These are just some different averages around different municipalities in the country. You see San Jose is the highest, but even that, on average, these businesses have just over a month worth of reserves. So it's a real problem. So we're all kind of in the US walking on a tightrope when it comes to this stuff. And the thing is, if cash was king, what if you didn't have to play that game? I mentioned before the Rich Dad, Poor Dad book, and this is a cash flow quadrant. Hopefully some of you have read, these are very powerful books. I read this book back in around early 2000s. And in this book, Robert talks about the four quadrants of income earners. Typically, you have an employee where you have a job, self-employed where you own a job, business owner where you own a system where people work for you, and then the investor where you have investments and the money's working for you. And in those books, he talks about how you really want to be on the right side. It almost makes it as if being on the left side is a bad thing. I remember for myself, I was firmly planted in the self-employed where I own my own job in that old business of mine. And I remember reading that book and being really kind of crestfallen, and just, it was a real slap in the face. And I realized, oh, I do, I just own my own job. I have no leverage. If I don't show up and do the work, it doesn't get done. And I had no leverage. I was really good at what I did, but no leverage at all. The nice thing about this, when you think about back to the banking equation, is that because banking is tied into all these different areas, which I showed before in the triangle, it's also inside all of these. So the employees have to use banks. Self-employed people have to use banks. Business owners have to deal with the banks, and investors have to deal with the banks. So if that's the case, that means that the banking equation exists in all these different areas. And to me, that's really good news. So that means that people on the employee side who may never want to start a business, because not everybody has the wherewithal to start a business. It's not easy. It's not for everybody. But that's okay. You can still be over here in the employee or self-employed section and take advantage of the banking function. And I'll be getting into that earlier. So again, if cash is king, where do the banks keep their money? This is something called BOLI, bank-owned life insurance. These are all publicly traded large banks in the US, and because they're publicly traded, they have to show where their cash is. So this represents cash that these banks have in life insurance, and they have to show. So Bank of America, $24+ billion. That's a lot of cash. Distinction here is so what they do is they take policies out on all their key people in their business. So you think about Bank of America, all the branches they have, all the offices they have, they purchase life insurance on all their officers, presidents, vice presidents, right down the line. And they pay for them, they own them, the cash is safely stored inside these life insurance contracts. And at some point they'll get a death benefit. So it's a perfect place for them to store a significant part of their wealth. And you might go, well, wouldn't they leave it in their own bank? Wouldn't that make sense? But no, because they know better. That's why I touched earlier on beating the banks, but join them. Look at what they're doing. I think it was Tony Robbins who talked about if you want to be successful at something, find someone who's really successful and just do what they do. It just applies with banks. They're the most successful money managers, and they really run the world in a lot of ways, for good or ill. And if we can just learn to do what they do, in large part, control that flow of money for ourselves, we can be in a great position. So these are, common versus uncommon. A lot of people, when they think of whole life insurance, this is what comes up. And unfortunately, there are a lot of gurus out there who espouse this and don't understand it. But it doesn't, it's not in their best interest to talk about how great whole life is versus some of the things that they're talking about, which are usually market related. So that they commonly, it's a low rate of return, it's expensive to own, and it's the worst investment of all time. Well, the reason is whole life insurance is not an investment. Repeat after me, whole life is not an investment. It's a completely different asset. I like this quote from Teddy Roosevelt from last century. Life insurance increases the stability of the business world, raises its moral tone, and puts a premium upon those habits of thrift and saving, which are so essential to the welfare of the people as a body. And I've been doing this for 10 years now, 11 years, and I'm really struck by the life insurance carriers that we use for infinite banking, the approach to that personal wealth. They're all mutual life insurance companies that have been doing it for a long time. And what that means when they're mutual means they're not publicly traded. They are not in the stock market at all. They have no share price. They have no shareholders. So they operate differently. And there's a reason that it works so well. So inside of these contracts, you have these guarantees and these different areas and different attributes to these whole life insurance contracts, which is part of the reason why these banks put so much of their money into these whole life insurance instruments. The guarantees, any kind of a savings account in a bank, is not guaranteed. There are some savings accounts, high yield savings accounts, that are pretty robust. First, it's taxable, and they can change at any time. So there really are no guarantees in there. The death benefit, obviously, that's the first thing people think about when they think of life insurance. A big death benefit that I will not benefit from, but my loved ones will. And that's great, but it doesn't really do me much good during my lifetime. But cash value inside of these things increases every year, guaranteed. You can't lose. As long as you're paying the premiums, you can never lose in these things. And the level premiums never go up. That's why it's called whole life. The premiums get locked in for the life of the contract. And then the constant compounding. So on this top here, you see, I talked about it before, where the savers, you tend to save up cash, pay for your thing, and then go back to zero. Save up for the next item you need, whether it's a car or whatever it happened, television, whatever that might be, pay for the item, then go back to zero again. And then on the underside is the borrower. So they just borrow from the banks and they get their things and then pay monthly to pay for the thing and then go back to zero. So that's typically what happens for people what they're not practicing what I'm talking about and becoming your own banker. The wealth creator, their money inside of the cash value is constantly growing and accelerating. That represents this green line here. They tap into it for the things they need. My wife and I, we have 2 cars, 2 Hyundais that we've financed out of our own policies. So this is exactly what we've done. We take out of it, get the thing we need, replenish it, and all the while the cash value is growing unimpeded with no market risk. And then liquidity. I like to think, a lot of times people think of savings and sort of I know I did for a long time. It was like a bad thing. It wasn't fun. If you're just squirreling away your money and setting it aside and you can't use it, what's the fun in that? When you're talking about this and these whole life insurance contracts, it's not just that where you're saving for a rainy day or for the things you need. It's also the opportunity that affords you when you have cash available. I mentioned before, I don't think when we went through bankruptcy, that 6-unit property that we had that was going to be like the next step up to our real estate empire, we gave it up as part of the bankruptcy. They told us we could keep it. We decided not to. We were kind of done with being hands-on landlords. And a couple of years later, it's probably 2010 or 11, I just drove by the place. It's not far from here. And it looked beautiful. And I saw the sign on the side, and it was this local company who goes in and refurbishes these old houses and makes them nice and then resells them. So that was an example of them having liquidity to take advantage of post 2008 recession. So the liquidity is not just for short-term savings and for a rainy day, it's also for opportunities as they arrive, because we had no opportunity to take advantage of those cheap houses. Like our property that we bought for probably $360,000, they probably got it for $150 in 2009 or whatever, when things bottomed out. So it's an important thing to keep in mind. It's not just savings, it's also for opportunities that may arise. And then the flexible loan provision. Sometimes you'll see people talking about this being like the main thing, and it's important. It's not the only thing, but when you tap into the cash value with these whole life contracts, you don't pull money out of it. You borrow from the life insurance company, collateralized by what's in your cash value. And they do charge an interest rate, but the loans is completely up to you how or even if you ever pay it back. You don't have to pay these loans back. It works best if you do, and you start to act like your own lending institution, where you borrow from the life insurance company based on what your cash value is for whatever you need, and then you just treat it like you're now Bank of America, but you're Bank of Hession or whoever you are. And you don't have to, because it's completely up to you. The reason that the life insurance companies do this is because they're on the hook for a death benefit at some future time. if there are outstanding loans when that person passes away, they simply subtract the outstanding loan balance from the death benefit and cut a check for your loved ones. So that's why they do it. It's very simple, and it's a very safe and easy loan for them to do, and they're contractually obligated to do it, to offer it to you as the client and as the owner of the life insurance contract. So these are unstructured loans. You have complete control. It really is, these policies operate sort of like a hybrid of a savings account with a robust growth inside of it and line of credit that you control, that compounds. It has a death benefit at the end too, and you have ultimate control of them. These are private contracts between yourself and a life insurance company. The only reason that the banks have to report what they have in cash is because they're publicly traded. All the contracts that my wife and I have with these policies, we have 9 of them. Over this 11 years, we have 9 policies on my kids, on ourselves, and they're part of our system. No one can look inside of them. What's inside of there is between ourselves and the life insurance company. If someone gets to a point where they are saving up for college for their kids and they want to perhaps take a loan out for college education, it makes sense to do so. If they have life insurance policies and cash value, they do not have to report it. Their banks and the colleges are not allowed to look inside of there, so they're very private. Just another really important piece of the puzzle. Monthly cash flow growth. You can actually look at these things as they mature and see just guaranteed tax-free monthly growth inside of these things. And then this is a huge part. I'm sure most people know that the death benefit is typically tax-free to your loved ones. But what they don't realize is that the internal and access to cash inside of these things, when set up properly, is all tax-free. This is just an interesting number where the national debt and where we are in $1 trillion, 31.6 is probably higher than that now, versus outstanding death benefits inside the life insurance industry. It's kind of interesting. Okay, remember, this is the Teddy Roosevelt quote again. And then this is another really important part, and that is the competitive yield inside of these things. So competitive, they're stronger than the guaranteed part is stronger than your typical savings account in a bank. Usually, right now it's around 3.5%. But that's not the total growth inside of it. These are what are called participating whole life insurance contracts. Participating means dividend paying, which means that these mutual companies, when they have a profit at the end of the year, they disperse the profits to the policy owners in the form of dividends. The way we set them up is we have the dividends buy more life insurance, which helps it grow, which keeps it tax-free, and it's just a beautiful thing. And the companies that we use and myself and fellow infinite banking practitioners use have been paying dividends every year for well over 100 years. One of my main carriers has been paying dividends for 175 straight years. So it just means that they're good at what they do. And another reason why we use these companies is they have a track record. This company in particular, pre-Civil War. So you think of a private financial institution and what it's been through: civil wars, world wars, pandemics, you name it, recessions, ups and downs, all kinds of things. And they're still just doing their thing. So it's a great place to park your money and run your money through, just like the banks do. These are some examples of real policies, which I think are useful to use. These are actually of my partner from Factum. These are legit. All of them are 6 years in length or less, except for one, and I'll point out which one that is. So this was actually one of my partners that they started a policy when their newborn was, I think it's 30 days old. Usually that's what they require for a newborn. They just want to make sure after the birth that the child has seen a pediatrician and everything's good. And they started, a policy. And the minimum just means that that's the minimum amount yearly to keep the policy in force. And then this is what they can put an extra $1,500 in per year if they want to. So that's what that means. And then this is 6 years in, there's $23,000 of cash value in there. So you can see there's actually more cash available than what they put into it. That ties back into the compounding part of these things. It takes a little while for the compounding to really kick in, but usually after year 5, 6, and 7 and ongoing, the internal growth inside of these things, all tax-free, is pretty remarkable. And then this is, you can see the monthly cash value growth and the death benefit, which also will be climbing every year because the dividends will be buying more life insurance. This is a 25-year-old who just out of college and is making a little bit of money and likes the idea of having control and having a safe place that's actually going to grow and he can control. And this is 1590 per year and as much as 4,000 per year. You can see the monthly cash flow growth, $183 per month, tax-free, just being added. And this is for savings and liquidity. And in this example, this is actually an older policy. This is, again, 2656 minimum. That's also called the base premium, and which is the required part of the premium annually, and then as much as 8,000 total. And you see is $87,000 of tax-free cash available to do whatever you want. And the death benefit, and see as these numbers get bigger and have been around longer, you get that monthly cash flow growth inside of these things. And then this is another example. This is a woman who is down in Arizona, near my partners where they live and where they operate out of Mesa. This is a woman who, her motivation for doing this was not so much cash flow, it was mostly for estate purposes. So in her case, I'll move this out of here. She had a family plot, a farm that had been in her family for a long time. Her mother had died quite a while back, and her father was a widower. And when he passed, it went to probate. Probate is what happens when the second spouse passes away, and the state says, okay, we're forming an estate here, and it's very public. They still actually put ads in the paper. I went through it with my mother recently. She passed in 2019, and even though she had no assets, she had to go through probate. And in the course of that, what happened was there were a lot of estate taxes due on the property because it was a big, valuable piece of property. And she and her siblings did not have the wherewithal to pay for that. So they lost it. They lost the land. And, it was heartbreaking for her. I've experienced that myself with a different property on my family's side. It wasn't estate taxes so much as it really was the liquidity. We didn't have the liquidity to purchase the property. It was an old house on a lake in Vermont. And it still breaks my heart to think about it. But in her case, they couldn't do anything about it. They had to let it go. She has since bought another piece of property, has some houses on it, and it's worth some money. And she wants to be sure that her heirs don't have to worry about that estate tax and that they'll be able to pay it and keep the property in the family. And then this is another example of a person, just a larger policy, 10,000 minimum annually, 25 total optional, $4.5 million death benefit, 4.2 million, and $1,200+ of cash flow every month. And then this is much bigger here. This is a very unique individual who's an entrepreneur who started quite young. He's only 30. Let me get this out of the way. 36, and he has the wherewithal to do a big policy. $250,000 required minimum per year, and up to 638,000. And you see when you get, this is $17,000 a month coming in for tax-free cash flow growth with a $37 million death benefit. So just to show you that there are a lot of different ways and different reasons that people start to do this thing called infinite banking and utilizing whole life insurance to manage and grow their wealth. And these are all the different areas that I touched on before. So this goes back to that original triangle that I brought up. And this is where I typically see various clients of mine come through. And they'll have some, they'll be at this bottom level where they're at the saver level. And maybe they don't have savings and they just want to have, if they understand and learn about this better environment to hold their money, and they'll get started on that. And we just started at that level, at a very basic level. Because I think middle America needs this. Because otherwise we're living paycheck to paycheck and hoping for the best, and maybe speculating in areas where we shouldn't be speculating. I talked before about with my wife and I, we were kind of dwelling in that the upper corner over here, and we really didn't have we shouldn't have been there, to put it, really, we weren't foundationally set up to dwell in that area. And when things went bad, that triangle got turned upside down, and things just fell apart for us. And then the second area is the wealth builder. That's when you get the foundation in, and you start getting the savings in, and then you start looking at these other areas. Is there debt that we can go after, and not just pay off debt, but actually buy debt? And that was something I learned from my mentor. You can actually turn debt into an asset when you set up the asset, which is the whole life insurance contract first. And then you get, as things go along, it's a process. You get a little bit more comfortable with how this whole thing works, and you become a business banker. And you're looking at cash flow management, investing strategies, and then ultimately you can get to that top part and become an infinite banker where you're just humming along and you're doing your thing and life is good. A lot of my clients are sort of straddling the blue area and this area. I have clients who are, if they have debt, we'll go after that first if it makes sense to do so. And then I have quite a few clients who are real estate investors. So they're looking at this as a way to store their cash until their next projects come up. You own real estate, there's always things breaking, things that need to be replaced. So it just gives you that opportunity. And then as they mature and things get more, as things go along and they can start to get into investment strategies, cash flow management. I'll touch on this real quick. Actually, my wife and I are kind of in this stage here because she has her own business. We started a living trust in a corporate structure, which has nothing to do with infinite banking, but it does have to do with wealth creation, and in that case, liability protection and tax savings. Which is so as things get a little bit more sophisticated, I would say, then you need and have access to these things that regular businesses already are practicing. And then you hit the top and get to where everything's humming along. You have an infinite banking strategy. I know people who are in a space where they have lots of cash in their policies and they're acting as a lender. They're identifying worthy causes or worthy businesses that they can get behind. Maybe there are businesses that are having a hard time getting loans from the bank. The banks, they require collateral, they require credit scores and all this stuff. So and that's kind of where I envision ourselves, my wife and I, being in the not too distant future, where the money that we have in our policies, that we're able to be lenders, where we're lending and at interest, reasonable, and then the money's coming back into our system to be used for whatever we need next. So banking versus investing. This is a pretty cool distinction. Investing is intentionally separating your control of money with the expectation that additional money returns in the future. What is banking? Banking is intentionally keeping your flow of money permanently in an environment where you have complete control and accessibility. They're very different things. Another way to think of these whole life insurance contracts I've seen described is it's the and asset. So you can be an infinite banker, have these whole life insurance contracts with cash value, and you can invest in crypto. You can have these policies and invest in real estate. It doesn't work the other way necessarily, because the left side, the whole life side and cash flow side is foundational. It allows you to do these other things. It's unique in that way. It's a unique and very powerful asset. So with this kind of information, typically most people, they don't know about this stuff, right? They're not taught in school how to be a banker, how to operate like a banker for yourself. And you can learn about this stuff and do nothing about it, and nothing will change. Now, you can take this information and implement it, and then you become a new you. I know our situation is so much different, having done this for the last 10 years with my family. There's a peace of mind and a knowledge that our money is running through these things that very safely. I'm not worried about it when the market goes crazy, one way or the other. It doesn't affect us. So, and that comes from implementation. So that concludes my presentation. I'm happy to, I'll stop share here. And I again apologize for the glitches earlier. I'm not sure, I couldn't, it wasn't working for me. So hopefully you got the gist of it. Any questions, I'm happy to answer any questions. And what do you say, Michael? Was that?
I think it was good. I'm going to spotlight myself here, and so that we're on screen together there. And I mean, I loved it. I get lots out of it each time, and it always opens up more questions. And so, for more details, but before I jump into my own questions for you, Michael, I want to see maybe we have anybody who's tuning in here who might have some questions. You can either raise your hand. Or there we go, type it in the
Oh,
chat like Nick just did. Is the premium each year based on the face value of the contract?
um, typically, no. It's different. And typically, with life insurance, what people will do is and financial people will take them through a process what they call human life value, and they'll figure out what you owe on your mortgage, income replacement, and stuff, and then they'll come up with a number like a death benefit amount, so that we're the main breadwinner, for example, or both parents, either or, pass away. There's some big chunk of death benefit that will pay the mortgage off and satisfy a certain amount of income requirement. We do the reverse, where what we're looking to do is to get as much money as we can in the form of premium into the policy, and we're not worried as much. The death benefit's important, but it's not the main focus. So it really depends. Everybody's a bit different. Typically, what I'll do with my clients is we'll come up with a premium amount that makes sense to them. So let's say it's not as big as you might think. I would say of my clients, probably the average total premium is maybe 15, 20,000 a year. Of that let's call it 20. Of that 20, depending on your age and health and how we set it up, maybe 30% of that goes into the base premium, which is that required part that in those examples. That's the annual base ongoing premium. And then the other 70% goes right into the cash value from day one. Whatever's in the cash value is what you can borrow against. And
What's face value?
face amount's the same thing as death benefit, basically.
Right. So what my understanding, and this is kind of my question as well, I kind of see what Nick's coming at. So let's say you base it on 10,000 premium.
Mhm.
What is the death benefit? What is that face value that I'm going to get at a $10,000 month?
Again, depends on age and health and stuff like
Right.
that.
That's what I would kind of figure. Yeah,
Yeah.
because that's going to
So
be how
yeah,
soon they're
like
going to have to pay out on it.
like younger people, that's a great question. Younger people will typically they'll get more death benefit with the same premium. So a 20-year-old super healthy paying 20,000 a year, that could be a $1 million policy.
Yeah.
A 50-year-old 20,000, it might be a $500,000 policy.
Yeah. So it's
It just
going to vary.
depends. Yeah.
Yeah, yeah. No, that makes sense. And then both Nick and Jan's questions kind of flow into one of the ones that I have.
Mhm.
Jan's question: how many years do you need to be in this to, realistically before you start the personal borrowing? And is there a minimum premium to get involved? So walk us through this. This is what I've always been wondering, because you and I have been chatting about this before, and I know we want to get started in this, Krista and I.
Mhm.
Let's say I go, Michael, we're starting today. Here's $10,000. I think that's the base minimum we've discussed, right?
That's sort of the lower range of
The
what
lowest,
for
yeah.
adults.
Yeah,
Adults.
yeah. But that's the minimum premium to get involved at all, right? Is
Yeah.
10K.
Yeah.
Okay.
I mean,
So,
let me just back up for a second. It doesn't have to be that. That's sort of like a guideline. I've got
mhm,
younger people who, 20 somethings who start maybe at 6,000 a year, 7,000 a
okay.
year. It's just like,
Okay.
if it's like 1,000 a year, it takes so long before you can
This is
have
going to take
cash
much
in there.
longer. Let's play with 10 also because
Okay.
that's an easy number then to play with. So let's
Okay.
say you start with 10, okay, $10,000, I get involved.
Mhm.
How long before I can borrow against that 10? And then how much can I borrow against that 10? And by the way, when I start at 10, that's an annual. So every year I need to add another 10. Am I understanding this piece correctly?
Yeah, it depends on, let's say, so what I'll do is we'll take a look and see what you have. A lot of times, and I'll run a free analysis and just get a sense of, do you have money sitting in savings? Do you have money sitting someplace that we could get put to work and get started on this? Because ideally, you want to think in terms of annual premium, at least to start with, which is the opposite of what most people think. They think it gets me the highest death benefit and what I can afford monthly.
Yep.
So if let's say if you said the total of 10 is all you're comfortable with, it would, let's say, someone who's, again, it depends on age. Like in your case, I know we're about the same age. Let's say half of that 10 would be base premium and half of it would be paid up additions, which goes right into the cash value.
Okay.
Older you get, that 30-70 split becomes more like a 50-50.
Okay. So back to
Make
the
sense?
question. So I put in 10.
Mhm.
How long before I can borrow against it? Should
Two,
be
2 to 4 weeks.
2 to 4 weeks. So
Yep.
2 to 4 weeks later, I can borrow some of that 10 back.
Yep.
How much can I borrow back? And that's going to be based on that 50-50 ish
Yeah.
or
Yeah. 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 And
okay.
the other thing that's really important to keep in mind is for a lot of people, they'll figure out some annual premium that makes sense for them, say it's 10 or 20, and they may have a chunk of money sitting in cash or sitting in savings. You can do a one-time dump in at the beginning of the year. I have a lot
Hmm.
of clients who do that, who are entrepreneurs. They'll, rather than, and then you can stick it in there and then just a one-time type of deal.
Yeah. Yeah.
So
So
you're,
now, so
yeah.
if I'm hearing this straight, so let's say I start and I go, I'm going to do a 10,000 and we'll do 10,000 every year. But
Mhm.
I start with that 10,000. I go, hey, by the way, we just sold a property over here.
Mhm.
I've got 50,000 extra and I can pop that in as a one-time dump. I'm not changing it to 60K a year.
Right.
I'm just popping that in. Now
Yeah.
that money that I put in there,
Mhm.
what percentage of that becomes available to be borrowed back by me
Mhm.
and how soon?
Yeah, usually it's about 90% of whatever's in the cash value at any time is
Okay.
what's available to borrow against. So in
Got it.
that case, let's say you did a 10,000 was your ongoing base premium and you dumped
Hmm.
in 50 at the beginning. You would probably have about, and 10 was the base premium, the ongoing base premium.
Hmm.
Probably, I don't know, 46, 47, $48,000 of that 50 dump in would be available 2 to 4 weeks later.
Wow, got it. Okay, so
And
pretty
then
pretty
after
high
that, in the
amount of it
following years, it's much quicker. It's just that very first time,
that
there's a little
first
bit
year,
of a
so it
lag.
takes a little longer. Yeah.
Yeah. But like in
And
year two, you pay another 10 grand. And the other thing
mhm,
too is that you wouldn't, all you have to pay is the base premium. They're very flexible. And
yeah,
you could, if another 50 was available, you could dump that in too.
dump in more.
And a
Right.
year after that, and you
Yeah.
can skip years too.
So I guess the bottom line question that I have, which is kind of like on how much, the basis for borrowing, it feels like at no point in time am I going to be able to borrow 100% of what I have in there, correct?
No, it's never more than
Never,
like 90% of whatever's in the cash value.
never more than 90%.
Yeah.
But then here's the part, the cash value is not necessarily what I put in. A certain amount of that is going towards other stuff. But usually it'll be 90% of whatever the cash value is.
Yeah. And that's constantly growing. Here's a good example. I had a client who was a veterinarian surgeon up in Chicago, and he had a pretty big policy, 50 grand a year, super healthy. He was about 56 or so at the time. And of the 50, 20 of it was the base premium, 30 of it was right into the cash value. That was the split. It was about a 40-60 split. Part of the reason we do it that way, if the IRS has rules around how much cash you put in right away. If you put too much right away, you lose all the tax advantages of it. So there's an art, you have to do it the right way. That's why there are those ratios.
Got it.
Because they changed the rules back in the 80s because
Yeah.
they realized, oh, so that's partly why we have to do that. In his case, he didn't need to take any loans out for anything. He had no debt. But then in year three, he had an opportunity to buy a kennel that was really had 20 employees, super cash flow positive, and he needed $100,000 to close the deal. The bank said, "Yeah, we're done. You're not getting any more from us." And
Yeah.
so he called me and said, "Hey, I have another 50,000 due for the premium coming up, and about a week later, I have to come up with $100,000. What should I do?" And I looked at him. I said, "Pay the premium, pay the 50 grand. A few days later, you'll have well over $100,000 to borrow." He had 110,000 he could have borrowed. He took 100 grand out. They fast tracked it, and he got it like a day or two later into his bank account, and they closed the deal on this
Okay.
business. So in his case, think about this. So he put in 150,000 in 3 years, really 2 years, because you pay these at the beginning of the year. Really, he did three payments in just over 2 years. So he kind of front loading these things. And you would think of that 50, 30 of it was going into the cash value. So you would think he'd have about 90,000 available, right? After three payments. Does that make sense?
Hmm.
He had 110. So the internal growth in the cash value with the guarantees and the dividends buying, it actually was growing better than we thought.
Continues to grow.
That
Got it.
happens.
Okay.
And that's what it started to compound.
Got it.
Yeah.
So there's another question in here from Nick that I'm going to try to answer and then see if I get it right. Okay.
Okay.
He says, you mentioned having 9 policies. Why have more than one? Is it to spread risk across companies or is it because it's for more than one person? I think it's like this, if I get it right, because I've
Mhm.
talked to Mike a little bit about this. So let's say we start with 10,000 because that's just happens to be the cash that we have on hand and we start this policy, but then maybe later we want to add another policy and do a little more. So we can continue to just stack it, if you will. And you could have those for other people too. I know you mentioned we should probably take one out for our children even and just put them in their names as well. But am I correct on the reasoning?
Yeah, you're spot on. Yeah, we the first one we started on 11 years ago. I just learned about this, and actually I left my first insurance company because they couldn't offer these whole life contracts like the ones that I do
Mm,
now. I was a captive agent, and all I could sell were these. It was life insurance, but it wasn't the same thing. It wasn't nearly as good. So I left.
mhm,
And but we had $24,000. It was part of my father-in-law's estate having been dispersed. So we had
mhm,
some money. So we started one on Annie, my wife, which was $4,000 annual premium and a $20,000 dump in that first year. So what we did was we took out loans and paid off a couple of high interest credit card debts. And
mhm,
then, so we had that, and once that one was kind of locked in, you couldn't make that any bigger the way it was set up. So then we got more cash flow positive, and then okay, we could do a $20,000 one on me now. So that's typically how it works. As cash flow gets better and you start to do it, you go, oh, we'll do another one. I have one each on my girls who are in their mid 20s
mhm,
now. We fund them and pay for them, and we use them. And at some point, we'll hand them over to them when they can
mhm.
pay for it and won't and don't
Right,
mess
right. Let
up.
them
So there'll
take it
be some
on.
certain
Yeah.
educational requirements on their part before I do that. So
Right,
that's
of
typically
course.
why. So yeah, and then the nice thing too about these I've more recently I found these two companies that do allow you to have you can do more of a dumping. So I could see where some people they wouldn't have to do as many because of
Hmm.
that ability to add in. So that's why it's just
Yeah.
each one is its own contract. So if you want to add more in, you start another policy.
Yeah. And I know for me, it's like when we had chatted about it, I'm like, we're probably ready to jump in and we'll probably start with the 10K policy, start to also to get our feet a little wet and learn how it works and start
Yep.
to master it because it seems like there's some complexities. In some ways it's simple, in other ways it feels kind of complex and I'd like to learn to master it more.
Mhm.
Nick's got another question. Wouldn't cash value grow faster inside of one account than spreading it across multiple?
Not necessarily. Because you think the internal rate is, and companies, someone I think mentioned earlier too, I do kind of, I didn't do it intentionally, but I do have policies with a company called Emeritus, with Mass Mutual and with Penn Mutual. So and they're all very similar. They have some subtle differences, but in the end, they all pretty much operate the same. So
Hmm.
really, I mean, part of the thing too to keep in mind as well is that the companies they're extraordinarily responsible. I think that's why they're very conservative. They do invest in very safe things because they have to grow. You saw the slide with all the death benefits, like $29 trillion of death benefit outstanding in life
Hmm.
insurance. They have to
Yeah.
pay for that at some point. So they have to invest in very safe things to grow everything. So they
Hmm.
take your premiums and they invest in bonds and very safe, corporate bonds, municipal bonds, and real estate. They weren't doing stuff back in 2008 like Goldman Sachs and Lehman Brothers. They don't do that. They're very conservative, and
Hmm.
so they just that's kind of how they grow, and it's just a beautiful thing, to know that it's very safe and you can tap into these things.
Yeah.
So it's kind of up to you, and they have restrictions on how big of a policy you can do because they view it as an expense. So let's say if someone's making $100,000 a year, they love the idea of whole life, and I'll put all my whole paycheck into it. They won't do it
Hmm.
because they have restrictions. They like doing about 25% of what your income is, or if you have reserves. So they have certain restrictions too. So that comes into the equation too. It's not like unfortunately, you can't just dump it in there like your entire paycheck. So
Right,
there's
right.
certain restrictions around that on their end.
Yeah.
You know.
So I want to, until we see another question up into the chat, I want to cover this aspect of it because I know this is something that I'm looking to do with you is and to be real clear with anybody watching now or anybody who watches a replay later, and any links we talk about, we'll put in the notes below the video. But the thing is that you don't charge for your services. Okay,
Correct.
correct? And
Yep.
what you would do, a best next step for someone who's interested in doing this would be to set up some time to chat with you and see, hey, is it a good fit? What's the best way to get started? All of that.
Yeah.
So we'll put a link. Do you have like a calendar booking
Yeah.
link?
Actually, yeah, I thought ahead and I put a little Word doc with both my
Perfect.
email and a calendar. Can I drop those in the chat or?
Yeah, yeah, yeah. So
Okay.
let's get that into the chat, and then we'll also be sure to put it in when the video goes live. There won't be a chat, but we'll put it in below that
Yeah, so that's
for
my
the
Calendly for
replay.
an hour long. I'm happy to chat, and then that's my website. And I have
Perfect.
an ebook called "What is Infinite Banking and Why Should You Care?" It's all about education
Yeah, it
because
really is.
so
You mentioned this book to me that
yes,
I ordered online as well to learn more about it, and it's really incredible. And in some ways, like I said, it sounds super easy, but in other ways, it's like there's some complexities. And for me, and I can't speak for everybody else who's watching this or attending right now, but for me, it's like yeah, I don't want to learn another thing too deeply. Now, I could. I'm also the kind of person, I do it more in my other edge of my business where I dig deep into it and I try to learn everything about it. This is one where I'd rather go, hey, look, you did all that homework. Let me just, trust
that's
you
totally
because
fine.
I've known you and I trust you. And
That's totally
so,
fine. It's funny, someone that we know mutually who's a client of mine. I've been trying to get him because there's a lot of education that I have access to,
yeah,
largely stuff I've already created, but also one of the reasons I partnered with Factum because they have a lot of resources. And I keep saying, hey, you should check this out. And he's like, I just want you to tell me what to do, and that's fine.
yeah, yeah.
I say, good. No worries.
Yeah, I don't want to become an expert at something else. I've already got these other things I'm an expert
Yeah.
at and
And
let you handle that
basically
part.
something comes up and you're like, hey, I was gonna make a buy a car. Yeah, sure, let's do that. Let's take a loan out from your company. I'll show you how to do it
Yeah.
and make the purchase, and then ideally say now you're the lender. And that money you were gonna send for the car, like car payments, just cycle it back in,
Yeah.
used
Comes back
again
to
in the
me.
future. So it can be done
Yeah.
very incrementally. Everyone's a little bit different.
Yeah, I love that. And there are, I mean, I could obviously dig deeper into some of the intricacies of it, which one thing, and I think we talked about this when the first time I ever heard you talk about it, I asked, but I want to still get a little, wrap my mind around it for clarity.
Mhm.
So I have this money that I've put in, and now I have access to borrow a portion of that. And
Mhm.
I borrow that portion to pay for a car. Now I'm making payments on it
Mhm.
back to the amount that I borrowed, which was my money anyway.
Mhm.
And when I make those payments back, am I paying interest?
Okay, great question. So what happens is when you take a loan out from the insurance company based on what's available in your cash value,
Hmm.
they do charge a simple interest rate. It's like five, some are 4.5% to 6%. Simple
Hmm.
interest. So, and the reason they do that is because they're just saying, look, you're taking out of their general fund, so that's money they can't
Use
apply and
themselves.
grow the whole
Yep.
thing, which is
Yep.
obviously that it's contractually you're allowed to do that.
Yeah.
Just simple interest rate. So what happens is if say if you were going to go buy a car and you had a $400 a month you were willing to spend on a car, you have the cash in, you say, okay, you could really get detailed about it and say, okay, we'll buy the car. We'll say the car dealership is going to charge, let's say 8%, and it's going to be this amount a month. We'll set up a payment back into the insurance company.
Hmm.
So what happens is these are all based on annual premiums. So if you take a loan out and you don't pay it fully back by the anniversary of when your next premiums are due, you'll get
Hmm.
a letter from the company and they'll say, hey, this is your base premium and here's your paid up addition is in the cash value premium and there's an outstanding loan balance interest of, let's say, $500, whatever that is. What I was taught and what I do and it works is you pay that interest back to the life insurance company because they just reapply it back into your cash value.
That's what I was wondering about because
You
it's
don't
like
lose it.
it's interest to you, really.
Yes,
It's you
it's
borrowing from
to the insurance
yourself.
company and they just reapply it to your cash value.
Perfect. Yeah.
And you don't have to do that. So not everyone does. Some people, I
Hmm.
think if they've been doing this for a while and they get older and they don't care, they
Yeah.
don't have to pay. They never put you on a payment plan.
Yeah. I mean,
It
I look at it
starts,
like, hey,
yeah,
I would have been paying interest to, the credit card company or to
yep,
the car loan company. And
yeah,
and so I'm into that habit of paying interest, but this way the interest goes to me
yeah,
anyway.
it gets reapplied. Yeah, yeah.
Yeah. So that's actually kind of cool. I like that.
Just like think like a banks at the heart of their business, they have money, they
Yeah.
lend it out at interest, and it comes back to them.
Yeah.
And just do that. And
Yeah.
so,
I like it. That
and you
sounds
don't
awesome.
have to do that. That's the other thing is it's up to
Well,
you.
right. That's also the other cool part, especially when you get up in years like I am, is like, hey, if I don't pay back, I'm not going to be the one collecting that
Right,
policy when
right,
I go.
exactly. Yeah.
So
It just, again, it does impact the death benefit
yeah.
and it can put a little bit of drag on the growth of it. So I say, look, if in general, if you take out loans, it's best to just pay it back in because you're going to need money for something else down the road.
Down the road. Yeah. Yeah.
And because you control it, you control the payment terms, however
Yeah.
that looks. So,
Yeah, no, I love it. I think it's a brilliant plan, and it's something that, like I said, we want to get rolling in. And obviously, I'm just going to trust you to handle it. I mean, I know, again, based on everything I've experienced with you and your education in it, it's like I don't have to be the expert. I'll trust you on it. So,
yeah.
so for anybody who's tuning in right now, if you're watching this in replay, the link is in the chat. If you're here live, otherwise, the link will be below the video. And check it out. Book a session with Michael and see if it's a fit for you, learn more of the details, get your questions answered one-on-one. And then if you do decide to do it, jump on in and Michael will direct it for you.
One last thing, just so people
Mhm.
know that I don't charge anything. So I get paid by the life insurance company once the premiums are paid. So there are no
Mhm.
fees on my end, just so you know that. And
Yep.
I don't pay attention like all those Fisher investment ads, they drive me nuts. Where they
Mhm.
somehow they make it's okay to charge, to earn fees and have money at risk in the market where you have no control over it. That's better than paying commissions to someone like me where it's in a safe thing with guarantees and no market risk. You tell me how that it's just such it kills me. But they've got a
Mhm.
big uh, marketing budget and they have a million ads out there. So just so people know, they
Yeah.
don't pay me a dime. Um, and
Yeah.
and it's just baked into the whole thing, and I'm
Yeah, yeah.
don't.
No, and it totally makes sense, and that's the best way to do it. And that's again why for me, I got the trust factor there because you're doing it yourself. You know about it. I've been, like I said, man. After I met you and started to learn about it, then it started to seem to be popping up everywhere. I was at an event just recently in Denver, and they had a main stage speaker talked about it, and just really, and the more I learn about it, and it's also one of those things where like, damn, I wish I'd known this, 40 years ago. Yeah,
Yeah,
Nick's going to reach out to you soon. That
yeah.
sounds great.
Thanks, Nick. Thanks for coming. Appreciate it.
Yeah.
Yeah, it's never too late. And I think, like I said before,
Yeah.
you can incorporate children, grandchildren, business partners. So
Yeah.
there are ways and owners. There's a lot of flexibility within it. So awesome.
Yeah. Yeah. And I'm
Cool.
going to get one for my son, and he's 22. But I also was telling him, I said, hey, I got this webinar coming up. I'm going to be learning more about it myself. But I said, this is something you should be doing at this age. I wish I had been doing it a long time ago.
Yeah,
So it's really cool. And I appreciate you sharing this with our tribe, with all
sure.
these people. And again, we'll get the video out there. And if you're watching this in replay later, grab the link, book some time, learn more about it, get involved in this. It's a great way to beat the banks at their own game. Or as Michael said, hey, if you can't beat them, join them,
Join them.
become one of them, be your own
Yeah,
bank.
you'll be much
So,
nicer and won't have as many requirements as you
exactly.
have. So
Exactly.
yeah, my pleasure, Michael. Thank you so much. I
You
appreciate
got it. Thank everybody for showing up, and we'll catch you on the next time we do some form of training. But in the meantime, enjoy this, jump in a call with Michael, and we'll catch you next time. Ciao, everybody.